Here's the number that will either motivate you or wake you up, depending on where you live. To afford the average Canadian home at today's prices and today's mortgage rates, passing the federal stress test with no other debts, you need a household income of approximately $130,000 to $150,000 per year. The median Canadian household income in 2026 is approximately $93,000. That gap between what the average Canadian earns and what the average Canadian home costs is the housing affordability crisis in a single comparison, and it is getting worse, not better. To buy the average home in Toronto in 2026, where the average price sits around $1,037,000, according to CREA's April 2026 data, you need a household income of approximately $218,000 per year. In Vancouver, average home price $1,209,774 in April 2026. You need a household income north of $240,000 per year. These are not exaggerations. These are the numbers produced by Canada's Federal Mortgage Stress Test, the OSFI B20 qualifying rules, which require you to prove you can afford your mortgage at a rate significantly higher than the one you'll actually pay. Most Canadians have no idea how the stress test works. Most Canadians don't know the exact income they need for their specific market. And most Canadians, earning median incomes, are trying to buy in markets where the required income is 2 to 3 times what they earn. This video breaks down exactly how the math works, what each major Canadian city actually requires, what most people get wrong, and the 3 paths forward for anyone who doesn't yet earn what their target market demands. Before we get to the city-by-city income requirements, you need to understand the rule that determines them, because most Canadians trying to buy a home don't fully grasp what the stress test actually does to their purchasing power. Here's the plain English version. When you apply for a mortgage in Canada, you don't just have to prove you can afford the rate the lender is offering you. You have to prove you can afford a rate that is either your contract rate plus 2% or 5.25%, whichever is higher. This is the OSFI B20 stress test. It was confirmed unchanged by OSFI in January 2026 and applies to virtually every bank and federally regulated lender in Canada. Here's what that means in practice in 2026. The lowest available 5-year fixed mortgage rate in Canada as of May 2026 is approximately 4.14%, according to Nesto. Add 2% to that, and your qualifying rate is 6.14%. You qualify at 6.14%, but pay at 4.14%. That 2 percentage point gap is enormous. It means your qualifying mortgage payment is dramatically higher than your actual payment, which directly reduces how much house you can afford. The 2 ratios that determine everything, GDS, gross debt service ratio. Your housing costs, mortgage payment at the qualifying rate, property tax, heat, and 50% of condo fees if applicable, must not exceed 39% of your gross monthly income. TDS, total debt service ratio. All your housing costs above, plus all other debt payments, car loan, credit cards, student loans, must not exceed 44% of your gross monthly income. In April 2026, with 5-year fixed rates around 4.04% to 4.29%, the operative qualifying rate is approximately 6.04% to 6.29%, well above the 5.25% floor. Every calculation in this video uses this qualifying rate. And here's the important new wrinkle. OSFI introduced a portfolio-level loan-to-income cap in October 2025, requiring lenders to ensure the average loan across their uninsured mortgage portfolio stays at or below 4.5 times borrower income. This affects how banks manage their overall lending, not your individual application directly. But it means the era of extreme stretch mortgages at the institutional level is being reined in. Your action step. Before you start house hunting in any market, run your own stress test numbers. Use the GDS formula. Take your target monthly mortgage payment at 6.29% plus your monthly property tax and heat estimate. If that total exceeds 39% of your gross monthly income, you do not currently qualify, regardless of what you can actually afford month to month. Here is the most important table in this video: the exact income required to qualify for the average home in each major Canadian city in 2026, based on the current stress test qualifying rate of approximately 6.29%, a 20% down payment, 25-year amortization, no other debts, and standard property tax and heat estimates. Now compare those income requirements to what Canadians actually earn. The median Canadian household income is approximately $93,000 in 2026. Only Edmonton and Winnipeg have average home prices affordable on that median income, with no other debts. Every other major Canadian city requires an income above the national median. In Toronto, the required income of $218,000 is more than double the median household income. In Vancouver, the $240,000 requirement is more than 2.5 times the median. And here's the important caveat the table doesn't show. These calculations assume zero other debt. No car loan, no credit card balance, no student loan, no personal loan. The moment other debt enters the picture, through the TDS ratio, the required income increases further. A buyer in Toronto with a $500 per month car payment and a $300 per month student loan payment needs to earn approximately $250,000 plus to qualify for the same $1,037,000 home. The national MLS Home Price Index was down 4.7% year-over-year in March 2026, meaning affordability has improved slightly from its 2022 peak. But the income gap between median earnings and required qualifying income remains the largest structural barrier to home ownership for the majority of working Canadians. Your action step: find your city in the table. Check your current household income. If there's a gap, the rest of this video is specifically for you. Here's where most first-time buyers get blindsided. They save the down payment. They pass the income test, and then they discover a list of upfront costs they never planned for. Let's build the complete upfront cost of buying the average Canadian home at $695,412 in 2026, with a 10% down payment. The down payment for a home priced between $500,000 and $999,999. The minimum down payment in Canada is 5% on the first $500,000 plus 10% on the remainder. On a $695,412 home, 5% of $500,000 equals $25,000. 10% of $195,412 equals $19,541. Total minimum down payment, $44,541. CMHC mortgage default insurance. Because the down payment is under 20%, CMHC insurance is mandatory. As of December 2024, the insured mortgage cap was raised to $1,499,999, meaning more buyers in expensive markets now qualify. On a $695,412 home with $44,541 down, The mortgage is $650,871. CMHC premium at 3.10% of the mortgage equals $20,177, added directly to your mortgage balance. Land transfer tax. In Ontario, the land transfer tax on a $695,412 home is approximately $11,408. Toronto buyers pay a second municipal land transfer tax, another $11,408. Ontario first-time buyers receive a rebate of up to $4,000 on provincial LTT, reducing it to approximately $7,408. Other closing costs, legal fees, and title insurance, approximately $2,000 to $3,000. Home inspection, approximately $500. Moving costs, approximately $1,000 to $2,000. Property adjustment payments at closing, approximately $500 to $1,500. Here is the complete upfront cash requirement for a $695,412 home, 10% down, Ontario. And that's not counting the CMHC premium of $20,177, which is added to your mortgage, not paid in cash, but which you will pay back in full over the amortization period. The total all-in cost before moving in on an average Canadian home with a minimum down payment, approximately $56,449 in cash, plus $20,177 in insurance added to your loan. Most first-time buyers saving $30,000 to $40,000 are not yet ready to close, even if they pass the income stress test. Your action step: add up your total available cash. Subtract your projected down payment, land transfer taxes for your province, and estimated closing costs. If the number is negative, your timeline to homeownership is longer than your down payment balance alone suggests. Let's be completely honest about what the monthly financial picture looks like once you've bought, because most coverage of mortgage affordability stops at the qualification stage. Qualifying for a mortgage and comfortably owning a home are two different things. Here's the complete monthly cost of owning the average Canadian home at $695,412 in 2026, with a 10% down payment and a 4.14% mortgage rate, 25-year amortization. On a household income of $145,000, the minimum qualifying income for the national average home, your monthly take-home in Ontario is approximately $9,200 per month. Housing costs consuming $4,912 of that represents 53.4% of your take-home pay, significantly above the traditionally recommended maximum of 30% to 35%. Even at the qualifying income, owning the average Canadian home is a financial stretch. In Toronto, it becomes untenable without a very high income. Each $100,000 in mortgage balance costs an average of $533.64 per month at Nesto's lowest 5-year fixed rate of 4.14% on a 25-year amortization. That per $100,000 figure is the most useful tool when comparing different price points. On a $480,000 mortgage, a $600,000 home with 20% down, $533.64 times 4.8 equals $2,561 per month in mortgage payments alone. On an $829,600 mortgage, Toronto average with 20% down, $533.64 times 8.296 equals $4,428 per month in mortgage payments alone, before property tax, insurance, or maintenance. This is why dual incomes have become essentially mandatory for home ownership in most major Canadian markets. A dual-income household with each partner earning $90,000 to $180,000 combined can qualify for roughly $800,000 to $850,000 at the stress test rate in Toronto. That opens up a much broader range of properties, but requires two full incomes simultaneously committed to the mortgage. Your action step: calculate your own monthly ownership cost for your target home using the $533.64 per $100,000 formula. Add property tax. Check your municipality's current mill rate, insurance estimate, and a 1% annual maintenance reserve divided by 12. Compare that total to your actual monthly take-home pay. That ratio, not the bank's approval, is your real affordability test. Here are the three paths forward. Not platitudes, not save more and wait. Specific, math-backed strategies for the Canadians whose income doesn't yet match what their target market demands. Path 1. Target a more affordable market. This is the most immediate and most underused lever. Canada's housing market in 2026 is not uniform. It is four very different stories unfolding simultaneously. Toronto and Vancouver are in buyer's territory. Prices down roughly 7% year over year, more inventory, longer days on market. Calgary and Montreal are tight sellers' markets, under 3 months of inventory, with steady demand. But the most affordable path for Canadians priced out of major markets is cities like Edmonton, where the average home is $450,000, and the qualifying income is approximately $94,000, within reach of a median household income. Winnipeg at $380,000 requires approximately $79,000, below the national median. Halifax and smaller Ontario cities offer meaningful affordability advantages over Toronto and Vancouver while still offering strong job markets and infrastructure. The question is not just, can I afford this market? It's, am I willing to live in a market I can actually afford? For many Canadians, that answer increasingly is yes, especially with remote work reducing the geographic constraint on employment. Path 2. Build income and down payment. Simultaneously, using the FHSA, the First Home Savings Account allows first-time buyers to contribute up to $8,000 per year to a lifetime maximum of $40,000. Contributions are tax-deductible, like an RRSP. Withdrawals for a qualifying home purchase are tax-free, like a TFSA. At a $90,000 income in Ontario, approximately a 30% marginal rate, an $8,000 FHSA contribution generates approximately $2,400 in tax refunds immediately. Reinvest that refund into your down payment savings. You are building your down payment while the government subsidizes $2,400 of it annually. Over 5 years of maximum FHSA contributions, $40,000 contributed plus approximately $12,000 in tax refunds equals $52,000 toward your down payment from one account. Combined with a dedicated TFSA savings strategy, a first-time buyer can accumulate a meaningful down payment within a disciplined 4 to 6 year timeline. Path 3. Improve your stress test position. Your qualifying income is not your only variable. Your TDS ratio, and therefore your qualifying power, can be improved by reducing your other debts. Every $500 per month in debt payments you eliminate increases your qualifying mortgage by approximately $80,000 to $100,000 at current qualifying rates. A buyer with a $500 per month car loan and a $300 per month student loan who eliminates both before applying increases their qualifying power by approximately $130,000 to $160,000, without earning a single dollar more. A 680 minimum credit score is required for standard mortgage approval. Moving from a 680 to a 750-plus score improves your rate options and negotiating position at qualification. Every point on the rate you receive reduces the qualifying rate and increases what you can afford. Your action step this week: calculate your income gap against your target market using Segment 2's table. Open an FHSA immediately if you haven't. Unused room from prior years carries forward, and the 2026 contribution limit is $8,000. List every recurring debt payment you carry and calculate the qualifying power you'd gain by eliminating each one. Let's come back to where we started. To afford the average Canadian home in 2026, you need a household income of approximately $130,000 to $150,000 per year, no other debts, and approximately $56,000 in cash at closing. The median Canadian household income is $93,000. That gap is real, it is structural, and for many Canadians, particularly single earners in major markets, it will not close through savings alone in the near term. But here's what's also true. The national MLS Home Price Index is down 4.7% year over year. Toronto and Vancouver, Canada's most expensive markets, are in buyer's territory for the first time in years, with more inventory, longer days on market, and genuine negotiating room. The Bank of Canada rate at 2.25% has brought mortgage rates to their most accessible level since 2022. For Canadians willing to target an affordable market, Edmonton and Winnipeg are within reach of median household incomes today. For those building toward a major market, the FHSA generates $52,000 in 5 years with tax refunds included. Eliminating a car loan and student loans adds $130,000 to $160,000 in qualifying power without a salary increase. For dual-income households, 2 earners at $90,000 each qualify for $800,000 to $850,000 in Toronto, enough to access the condo market that is currently softer than any point in recent memory. The income required to buy a home in Canada in 2026 is a challenging number for most Canadians. It's not an impossible one. When the right strategy, the right market, and the right timing come together. You now have the numbers. You have the 3 paths. Run your own calculation. Make the decision from data, not from hope, not from fear, and not from what your parents did in a completely different housing market.